Hi everyone, my name is Oghoorian. I'm with ACap Advisors and Accountants. I'm a CPA and I'm also a certified financial planner. And today we want to take a little bit of a different approach, and instead of doing a webinar, but doing a webinar that is a panel discussion. And the idea behind that is that we want to provide thought-provoking ideas and be actual thought leaders in a particular subject matter. And in this case, we're going to talk about opportunity zones, which are really, really new, and as a result of the new Tax Cuts and Jobs Act. And instead of having one person talk about what, in this case, I would know about opportunity zones, I thought I'd bring in two other experts who can really delve deeper into opportunity zones and see how we can help our respective clients and other people that might be watching and learn something new. So a little bit more about myself, and then I'll pass it on to my fellow panelists. As I said, I'm Oghoorian with ACap Advisors and Accountants. We're both a financial planning firm, and we're also a CPA firm. We have a unique focus, and we work predominantly with healthcare professionals. That's a big part of our clientele, but we have clients in other industries as well, primarily in the service sector. To my left is Andrew Barnett of Boroda Homes, and next to him is Steve Post from Weiss Accountancy. And I'll pass it on to Andrew, and you can introduce yourself. And
Awesome. As Ara said, Andrew Barnett from Boroda Holm. We're a full-service CPA firm based in Encino. We do everything tax, accounting, auditing. I specialize in accounting and auditing for manufacturing clientele.
Thank you, Ara, for having me. My name is Steve Post. I'm a CPA with Weiss Accountancy. We're a 40-person firm helping small business owners with anything and everything that sort of comes their way in tax accounting, and I personally do business valuation work as well. Our client base is typically manufacturers in the Valley, real estate families, and anyone with a small business just looking to get some assistance.
so neither one of you primarily focus on service-based organizations or businesses, right? You guys do both manufacturing and service-based.
Yes.
Yeah.
Okay. Do any of you guys do audit at all?
Yeah.
Yeah.
Okay, so that's good. So talk a little bit about your audit work and what you guys do in that respect.
So we do all types of auditing, from financial, 401k, basically any private business that needs an audit, we can handle that.
Yeah. So yeah, we also do audit work for clients where they either have a lender or an investor relationship that requires an audit, or that they're looking to potentially sell at some point. And within that vein, with the audit work, I also get involved in due diligence with deals and potential business sales and structure, et cetera.
Okay. All right, so let's dive right into the opportunity zones, because if you haven't heard about opportunity zones, you're going to start hearing about them a lot more. And the opportunity zones are as a result of the new Tax Cuts and Jobs Act that went into effect January 1st, 2018. And it's huge. Most people think about the tax law changes that went into effect for individuals and some businesses, but this is a little known tax change that went into effect that is going to become more broadly popular among the general population. So let's start off with the first question: is what is an opportunity zone? So maybe we'll start off with you, Andrew, and off to Steve.
Okay. So yeah, an opportunity zone is a low income area that the state and the IRS has deemed an area that needs improvement, that they think bringing in outside investors to improve would help the area.
So
like,
how did they identify the areas? I don't know, Steve, if you want to maybe.
Yeah. So actually, the IRS decided the Congress decided in the tax code that every state is going to have opportunity zones, and so it's up to each state to determine their own zones. Mm-hmm. And so from what I understand, there's been some politics because every state wants to have different areas where it's not just all in the northern part of the state or the southern part. So there's tracts in every county of these states, as long as they meet the demographic requirements to be there. So here in Los Angeles, we have areas just like other counties. In the Bay Area, we'll have tracts as well.
So when I understand, I'm sorry, go ahead.
It's in all 50 states, and I think it actually makes up like 10% of the country. Mm-hmm. I heard, but not all zones are created equal. Some are in better areas than others, but it was up to, again, as Steve said, the governors of the state to choose that area.
Yeah, and I think the local politics definitely play a factor into it as much as we can or cannot see it.
When I was looking at the map and seeing like some parts of East LA or Eastern Culver City being part of the opportunity zone, like, are you kidding me? These places are like,
No, but
they're definitely not qualified area.
We have a lot of clients that are already located in opportunity zones with great businesses, and so it could be that they were designated that way because the income levels or whatever the demographic features were not up to the higher caliber. But it's a great area for business.
Yeah, absolutely. And also in the valley as well, there's some areas that are classified as opportunity zones. I think there was one of the criteria was poverty level, right? There's a certain percentage of the individuals in that area have to be below the national poverty line. And then the governor of the state basically identifies what those areas are, submits them to the IRS, and the IRS or Treasury determines those. And there's a heat map, interactive map that you can go. I'm not sure what the website is, but we can have it on our webinar below. And that heat map where you can put in your zip code and it'll tell you kind of where the opportunity zones are near you.
Yes.
Okay, so we talked about where the opportunity zones are, but let's talk about some of the tax benefits associated with them. So what are some of the mechanics? Like, now we have an opportunity zone. What happened? Like, what can you do with that opportunity zone? I know you can. It's very similar to a 1031 exchange, and that you can defer some capital gains taxation of it. But let's dive a little bit deeper and see, what are some of the benefits of the opportunity zone tax-wise? So whichever one you
start
want
with this one.
The main benefit of investing in an opportunity zone is the capital gain deferral. So the question is if there's a person that has a large capital gain, whether it's from the sale of stock or the sale of a business or any other type of capital gain that they might have, how can we avoid paying the tax today? What can we do with it and continue earning a return on our money? And investing in the opportunity zone is that answer.
Right. And how you would do that is someone has to create an opportunity zone fund, and that is the entity that you would use to invest in the zone, basically. And with that, the fund can invest in basically 3 different types. It's either business, property, or it could be stock in a company or a partnership interest in a company as well. And there's some criteria that needs to be met in order to qualify for the opportunity zone fund. But yeah, that's the main investment.
All right, well, we're going to circle back to the fund part of it because there's a difference between the opportunity zone and opportunity fund, which I think there's a lot of confusion among the general public, but we want to circle back to it later on and get some more clarification on it. But before we do that, there's some certain key dates that need to be remembered when we're talking about opportunity zones and the tax benefits associated with it. And the dates are the 5-year, 7-year, and 10-year periods. So maybe we can talk a little bit about that. Like, what are the benefits of holding it 5 years? Because there's a tax, step up in basis on that. What are the benefits of holding it 7 years? And then the real benefit really comes in after that 10-year period. So maybe you can start, Steve, on that one. And
Sure. So the main benefit that we're talking about is a capital gains tax deferral. So if you don't have to pay the tax today and you can defer it under the law until 2026, you still owe the tax. So whether it's today or tomorrow, you have the time value of money. That part is great. In addition, if you invest and you hold 5 years, we'll give you a break on the tax. Now you only have to pay 90% of it. And if you make it 7 years, then we'll give you an additional 5% break, and you only pay tax on 85% of what would be due at that point. You want to touch about the 10-year?
Sure. So yeah, as Steve said, it's really just a deferral of the capital gains. And that would be due in 2026. But for the 10-year period, it's basically, if you hold the investment for 10 years, you're able to step up that investment to fair market value so that when you sell it, there'll be no capital gains tax at that point.
Right.
Whether that be at 2026 or at any point after the 10 years, you can sell that investment.
Okay, so that key line of demarcation is December 2026. I mean, you have to hold it till that point to get the full step up in basis and get the full benefit of capital gains exemption in that sense, right, for what you invested in?
So 2026, the tax is due no matter what. The question is how much. Whether it's 100% of the tax if you haven't met the 5 or 7 year, or is it 90% or is it 85%?
What if it's been you've held it for 10 years?
Well, we're in 2019, so we can't we can't get a 10-year deferral. So that tax is going to be due no matter what. But here we are in 2019. If you can hold till 2029, you paid the tax, you step up your basis, and you don't pay any further gains from that point on.
Right. Okay. That's great. I mean, it seems like it's a very flexible opportunity out there for a lot of people.
And then with the 2026, in order to hold it for 7 years, you have to invest in the Opportunity Zone Fund by the end of this year in order to get the full 15% deferral and get it down to 85%.
That's a great point on the timing, how critical it is that people really look at this right now for that benefit.
Right, exactly.
So I want to touch a little bit on that because, and it just delves into the between opportunity zones and opportunity fund. If you're investing directly into an opportunity zone, there's not only that initial contribution you make in there, there's not only that initial capital gains that you deferred into that, but there's an additional investment you have to make in that area as well, right? Is that not true?
Yeah, no. So in order to qualify as opportunity zone property, there has to be substantial redevelopment or improvements brought into the zone. That's the whole point of this public policy, is that we're going to bring these areas up and we're going to invest in these areas. And so because of that, you're going to end up having people that are putting their capital gains in. It's going to be the funds that can really circulate more money to do the improvements that are necessary to qualify the property. For a person doing it themselves, the challenge becomes. Do you want me to go?
Yeah, go ahead. Because you got to add the other second part of it, right?
Yeah, the challenge becomes the substantial renovation piece, and so only the capital gains piece is going to get any of these benefits. The additional money that you bring in gets no benefits of the opportunity zone. So
it just raises your basis in those properties.
So I mean, that's an important point. You're absolutely sorry. I didn't mean to cut you off.
No problem. And then I think with the new regs, they went more into the substantial improvement and said if it's in initial use, then there is no improvement necessary. So if you were, for example, to buy a property that's being built but not fully built yet, then there's no additional improvement necessary because that's initial use of that property.
Okay. So let's shift gears a little bit, talk about the 1031 exchange briefly because it ties back to this a little bit. The 1031 exchange, as we all know, changed dramatically. So now it has to be a like-kind property that you're exchanging. And I think they did this because now they've got the Opportunity Fund as kind of, in a sense, an alternative. How is the Opportunity Fund better, if at all? I'm sorry. Yeah, how is the Opportunity Fund better, if at all, than the 1031? Because in my impression, the Opportunity Fund, you can take any kind of gain. I mean, you could take Amazon stock gains or Apple gains and defer it into an opportunity zone, which with the 1031 you can't do that. And is that the case, or?
Yeah, absolutely. I think that's the main benefit of the Opportunity Fund is taking your stock gains or your sale of a business or even the collectibles collection and monetizing it and diversifying and getting into an opportunity fund without having to pay the tax today.
And the cool thing about if you take a collectibles gain is, collectibles typically are taxed at a higher rate than capital gains tax are. So you're effectively taking a higher taxed asset and putting it into a lower tax potential investment.
Yeah.
Right. Yeah. The main thing, as Steve said, is it's the diversification that you're able to do by taking any type of capital gain and making it real estate. While with the 1031 exchange, it has to be like kind, so property for property.
And the other benefit is that with a 1031, you have to go through an intermediator. So you have to have a particular 1031 exchange escrow company that handles all that, and you have very tight timelines to do this.
Yeah, 45 days to find the property, 180 to close, which is similar to the Opportunity Zone.
Right.
And then the other thing is basically for the Opportunity Zone, you only have to take the capital gain. Mm-hmm. But for the 1031 exchange, it has to be the entire amount. Right. The total mortgage, total cash out, or else you're paying tax on the difference, basically.
Yeah, so this is a lot more flexible. And also you can have sold the property, whether it's stock or collectibles, and hold on to it for 179 days and then do the Opportunity Zone as long as it's within that 180-day period.
Right, exactly.
Yeah, you actually just have to get the money into the Opportunity Fund.
Right.
The fund is then required to put in the money into an Opportunity Zone property, and that could be another 6-month time frame.
So when does your holding period start then? If you put it, that's a good point. If you put into the fund, let's say January 1st, and the fund doesn't invest in the property until June, does your clock start January 1st, or does it start in June?
Once you make the investment, then
In the fund?
you've made your 180-day. You've met that rule.
So a lot of what we're talking about is federal tax related. Federal tax related. Why don't we talk about the state tax? I mean, are there any benefits or implications on a state level? I mean, we're in California here, so let's talk about California state taxes.
At this point, California has not followed the federal rules with the opportunity zone. So you don't get to defer any of the tax, no matter what that capital gain is going to be due when you file your returns that year. So.
Anything to add to that, Steve?
Yeah, I think so. That point is exactly on target here. With the issue being, if you have very low basis and all gain, you have a high tax bill to pay to California now. Mm-hmm. If you have a scenario where you had $800,000 of basis and you sold for $1 million, so you've got a $200,000 gain, you can still put $200,000 into a fund. You can still cover your California tax, and you still have some money left over after all of that. So it's going to depend on the scenario, how liquid clients are, and where what can they do with their money to meet all of these different obligations.
I heard the governor's new budget proposal. I mean, it hasn't passed yet, but is going to have some equivalent of an opportunity zone tax benefit for state of California. I mean, who knows if it's going to go anywhere, but
there is potential there.
Yeah, definitely.
But the problem, as we discussed before, is the 7-year period has to be invested by the end of this year, and who knows if it'll go into effect by then.
Yeah. Well, knowing the California legislature, then we can't put a lot of faith into that. So we talked about all the good things about the opportunity zones. Are there any downsides that you can think of that relate to opportunity zones and investing in them? Like things like pitfalls that people should know about, or?
You just have to be able to know the risks involved and the expenses, because the main benefit of the opportunity zone, besides the deferral, that's only pushing the tax down the line because you're going to owe that no matter what. But the main benefit is after the 10-year period that you're able to step up the new property to fair market value and basically wipe out the tax on that gain. If the property doesn't go up in value, then you're losing the main benefit of the opportunity zone fund.
Okay, that's a good point. Anything else to add to that?
I think you weigh this against all other investment opportunities. So is this opportunity to invest with a fund where they're charging fees? A lot of them operate like hedge funds with a 2 and 20 carry. They're going to have developer and management fees. The returns on that versus the returns you get with your stock portfolio versus your other real estate opportunities and so forth. How do you balance all of that?
Right, that's a good point. And kind of taking off my tax hat and putting my financial planning hat on, and talk a little bit more about the investment component of it. Especially if you take something like an appreciated Apple or Amazon, whatever stock it is, and you put it into an opportunity zone or an opportunity fund, you've essentially taken a very liquid investment and you created a very, very illiquid. So that's one aspect of it you have to take into consideration. And then if it's a large amount of money, then you're talking about a big part of your portfolio that is very concentrated in a particular sector. So that's one thing you have to take into consideration. Acting like a hedge fund, the 2 and 20 rule is very important because a lot of people don't understand basically how a 2 and 20 structure works. Although I think very few hedge funds even do 2 and 20. It's like now 1 and 20. But it's continuing the same example of the 2 and 20. It's 2% of assets under management that they bill, and then 20% of the profits with a high water mark. What that means is if the investment is 100 and it goes up to 120, then you pay 20% of that $20 that went up in value. But if the investment goes back down to 115 and it goes back up to 120, you don't pay again on that 5% or $5 difference because you've already paid that. That high watermark is at that $20 amount. So it's important for people to keep that in mind if the fee structure of the fund is a 2 and 20 or 1 and 20, to make sure it's got that high watermark so they don't get that fee double. They don't have to pay that fee twice. That makes sense.
Yeah, and the other so there's two choices. One is to invest with a group, or there's tons of these funds sprouting up. Mm-hmm. And choice 2 is to do this on your own. And the regulations are still just coming out. They're very complex. To make sure that you've met all of the different requirements. There are reporting requirements. There's the deployment of capital requirements and so forth. And so I think the average investor has to really get up to speed if they're going to do this as their vehicle of choice.
Yeah, and it's a good segue into why it's important to work with a trusted CPA that knows really understands the tax laws and understands the nuances between this, so that way we can guide them through what the most important aspects of it are. Because all you need to make is just one mistake, and IRS may be a little bit, understanding, although not too much. But FTB, Franchise Tax Board, forget about it. I mean, they're absolutely ruthless.
Exactly.
Even if you just sign it wrong, they'll
Good luck.
Exactly.
So, as far as the investment vehicle is concerned, can you do it through a pass-through entity like an LLC, an S corp? Can you do it through a trust? Does it have to be a particular type of entity that you invest in?
It could be any type of entity. Actually, one benefit of if it's a S corp is the 180-day rule. If it flows through to the individual, then the 180 days could start either at the date of sale, or it could start as of the end of the year, because that's when the individual would know that they have a capital gain. So there's a huge plus that they can make a sale through an S corp in March, but the 180 days would start in December.
Okay, all right, it's good. I didn't know that. Yeah. So, anything else you want to add to that, Steve? Or
you can make you can deploy it individually, or you can deploy it through through an existing entity.
Right. Okay. The question I was going to ask, it kind of set my mind a little bit on the investment. Anything you want to add before I kind of remember what my next question is? Because I do remember, it's kind of slipped my mind what I was going to ask related to the fund. Oh, this one. So as we're evaluating different types of opportunity funds, well, first I don't think we clearly define opportunity zone and opportunity fund. Let's do that first, and then let's go further and talk about how do we evaluate the different opportunity funds? Because as you said, they're sprouting up everywhere. How do you evaluate the different funds? Which one's a good one? Which one's a bad one? Can you really get a fund that's geographically dispersed out, or one that's very concentrated in a particular area? So let's first define the difference between opportunity zone and opportunity fund. So I don't know if one of you guys want to take it.
We already discussed the zone is the area, and the fund is the vehicle to invest in that area.
I think from a broader institutional-based funds, their prospectus will have to identify what areas or what industries or what type of businesses that they're going to be investing in.
Mm-hmm.
So it's obviously making sure that you read the prospectus and understand the risks and that are involved with whatever the setup is in that regard. From what I've read, the funds, they may also have issues where they can exit opportunity zone properties and reinvest into other opportunity zone properties
without implications for you.
While you, the investor, are still just invested in the fund. Because they have to meet their capital deployment of people coming in and out, and meeting their requirements to maintain certification.
So, that's an excellent point, and that's actually a really good value for going through an opportunity fund instead of a zone, because with the zone, I think at first glance, it's really difficult for an individual to invest in an opportunity zone. I think once these places were announced, I think a lot of the funds and REITs kind of got in there and started buying these places. But the flexibility that an individual investor can have investing in a fund for the exact reasons you mentioned, I think are very important.
Yeah.
So, you're pushing the requirements to the fund managers instead of having to do it individually, which is a huge benefit for sure. There's some costs involved with that,
right? But
at least you're going to be sure that it's going to qualify, and there won't be issues like that.
So when you invest in these funds, I'm assuming we're going to get a K1, depending on whether it's a partnership or an S corp. I'm assuming most of these are taxes partnerships, and you get a K1 associated with it. Okay.
That's right, which is a great point to actually touch on, is that although you have a capital gain deferral, there's no income deferral. So if the fund is investing in income producing property, you could still be liable and responsible for taxes, and because the fund is throwing off income to you and passing it through. The question becomes, what is the distribution policy, and are the distributions a return of capital, or are they returns of income?
The return of income,
and so so that's one of the issues to be addressed, sort of in the proposed regs that are being dealt with now.
But also a huge benefit. So you would have to report the income, But then with the accelerated depreciation and the improvement requirement of the fund, hopefully there will be some losses that could help for those years as well.
You won't be able to take them anyway, though.
Yeah,
So.
yeah.
But I mean, as far as the income, it would be really juicy if you could also defer the income and avoid that. But obviously, that's not going to happen.
Yeah.
So, where can people go to get more information about this? Not only information about opportunity zones, but about you guys respectively. So we're going to have all of our information on the webinar as well. But why don't we just verbally tell a little more about how people can get in touch with you and more about opportunity funds, and then if there's any closing comments or remarks, we can do that as well.
So as I said, I'm Andrew Barnett from Boroda Holm. You can contact us. Our website is bhfirm.net, and the phone number is 818-905-9550.
So do you have a geographic area that you primarily work in, or is it?
We're all over LA. We're based in Encino, but we have clientele all over Southern California.
Okay, how about you, Steve?
You can go to our website, Weiss Accountancy. It's weissac.com, WEISSAC.com. Call or email is great. And the main demographic we serve is LA and California, but we do have clients out of state with various business ventures. You can also catch me on LinkedIn or anywhere else. Not too active.
We'll have all of our.
I've never posted anything.
Well,
You see who I am.
we're definitely going to be posting this on LinkedIn and social media and all that. But we'll have
first.
we'll have all of our contact information below. As far as how to get in touch with us, I'm Oghoorian with ACap Advisors and Accountants. We have clients not only throughout LA and Southern California, but all throughout California. We have clients actually in almost every state as well. On the tax side, it's predominantly within California, but we do have some that are out of state. And our focus is predominantly with healthcare professionals. So we try to stay within our lane as far as the types of businesses that we work with. We don't do manufacturing or retail or anything like that. We primarily do professional service corporations. So people like physicians or radiologists or chiropractors, things like that. So primarily professional service corporations is who we work with. And most of those individuals like to buy their own building, or like to buy investment in real estate, or if they've got appreciated assets they want to defer. The opportunity zones and funds are great ways of doing that. So I wanted to thank you guys for participating in this panel. I think it was very informative for not only ourselves, but all the viewers are going to be kind of tuning in.
Thanks for including us.
Yeah, thank you so much for the opportunity to be here.
Yeah, we're trying to talk about opportunity zones. Any other closing comments that we didn't talk about already? Like anything that
there were a couple other pitfalls that we could.
Oh yeah, go ahead.
Slipped my mind.
The main thing is just knowing all the risks and expenses involved with the opportunity zone to make sure that it is a good investment for you and for your portfolio.
Oh, and one of the other things is for clients that do invest in the opportunity zone, but they pass away between now and 2026. My understanding is that the taxes don't go away, so it'll be part of the estate. But there's no step up in basis either. So because you haven't dealt with recognizing the gain, and so there's some looking at it from a client perspective of life expectancy to a certain extent, and their estate plan and looking at things, you might want to just reevaluate.
That's an interesting point. So does the beneficiary adopt the basis of the person who passed? So if they bought this property many years ago, then bought the asset many years ago,
because they got to pay the tax.
Wow, okay, that's a really good point.
Another one is that the designated zones have been designated for 10 years currently, and it's possible that the government is going to come out with new zones at the end of the 10 years based on what the new demographics are. So the question will be, do you have to exit the existing zone, go to a new zone? What kind of grandfather clauses are going to be in place?
And basically, I think the bottom line is don't try to do this on your own. Really, really hire someone like us that really understands the tax nuances between this and the changes that are going on all the time, and to make sure that you're in compliance. So otherwise, you're going to cause a headache not only for yourselves, but also for your decedents. So.
Exactly.
Yeah.
Okay, thanks again. Appreciate it. thank you for joining us for this webinar. If you have any questions or any clarification on anything, please contact us in the email below. We will make sure to address all the questions. If we see that we have a lot of questions on a particular topic, then what we'll do is we'll do another webinar where we'll dive deeper into a particular subject matter and provide more insight and guidance for you.